Okay, so we have to talk about finance and markets because I think we're being lied to. We're being told that the AI revolution is this unstoppable force, backed by endless capital transforming the future. And you see headlines like the one from yesterday. Wall Street giants like Apollo, Blackstone, and Goldman Sachs are partnering with NVIDIA on a $500 billion AI financing deal, one of the largest private capital raises in Wall Street history. Now, that sounds like a vote of confidence, right? Big money backing big tech. But what if that money, when it inevitably goes bad, is already set up to be paid for by you, the taxpayer? David Dan of the American Prospect has identified a potential backdoor bailout mechanism that may already be established. If you see that once, it could be a coincidence, but it's happened 3 times. That's a pattern. Welcome to the Alpha Brief. I'm Marcus Reid, and if you're new here, we follow the money so you don't have to. Today, we're going to expose how the AI buildout, fueled by opaque private credit, could be laying the groundwork for state taxpayers to fund the largest bailout in history. If you own a home, this story means a hidden tax on your property could rise to cover losses you never signed up for. If you're carrying any debt, the cost of borrowing might climb as state finances strain under unexpected burdens. If your paycheck hasn't moved much lately, imagine what happens when your state's budget is diverted to cover private sector losses. For your retirement savings, the volatility unleashed by a potential AI bubble pop could shake the foundations of even the most diversified portfolios. This isn't abstract economic theory. This is about your wallet, your state's ability to fund schools and roads, and the stability of your financial future. Now, stay with me on this, because it's a little complex, but it's critical. For several years now, we've been tracking the incredible developments in the AI space. The promises are immense, but so are the questions about whether this entire build-out, this massive capital expansion, is just a bubble waiting to pop. And if it does pop, what then? Who pays the bill? That's where the work of David Dan from the American Prospect comes in. He's been digging into a mechanism that could shift the risk of this AI bubble from the private equity firms and their investors directly onto state taxpayers. His headline says it all. The AI bailout could be baked into the AI bubble. And here's why that's not just hyperbole. Private credit companies are key owners of AI-related assets. These aren't your traditional banks, right? They operate in the shadows, lending money to projects and then companies in ways that are far less transparent and far less regulated. And many of their parent private equity firms, the big players you know, they also own life insurance companies. Firms like Apollo, which owns Athen, or KKR, which has a couple of different life insurers under its wing. And these aren't your grandparents' life insurers. Their portfolios are structured very differently. A significant amount of these private credit loans, many of them tied directly to the AI build-out, things like data centers, are making their way onto the balance sheets of these life insurance companies. Think of it as a financial game of hot potato, but with your money potentially on the line. This opaque system allows private equity to offload risk in ways that traditional banking regulations prevent, creating a hidden vulnerability in the financial system. So here's where it gets weird, and where the potential for a backdoor bailout truly emerges. When a life insurance company becomes insolvent, it doesn't go through the traditional bankruptcy system. And there's a good public policy reason for that. People rely on these policies when loved ones die. You don't want those promises to just disappear. So in almost every state, there's a system where surviving insurance companies are assessed after the fact to cover the policies of the insolvent firm. It's like deposit insurance, but with one key critical difference. David Dan said, and I quote, "In deposit insurance, the assessments are made before a company goes bankrupt. So all banks pay into this fund. And when there is an insolvency that bank, those deposits are covered by the amount of money in the fund. With life insurance, if there's an insolvency, only the surviving companies end up paying for the insolvent firm to back up those policies." Now, that sounds okay, right? Other companies pick up the tab. But here's the kicker, the part that ropes in the taxpayer. In 44 states, those surviving firms then get a tax credit. A tax credit equal to 100% of the assessment they just made. So, who ultimately pays for it? State taxpayers. You. This is where the AI bubble ties in. Many of these private credit loans, these bespoke, hard-to-value loans, are financing the construction of massive data centers, the literal infrastructure of the AI revolution. And David Dan's theory is that this kind of private credit, with its AI-related assets, makes these life insurer insolvencies a bit more likely. If that's the case, then the popping of the AI bubble could trigger this process. State taxpayers would essentially be paying for the sins, the over-leveraged bets of these life insurance companies owned by private equity. David Dan said, and I quote, "Private credit is essentially the credit arm of private equity. So, most private equity firms now are these sort of full-service entities and platforms, and private credit is their lending arm. It's a shadow banking system, largely unregulated. Most private credit loans are to portfolio companies that the private equity firm already owns. And many of those companies, especially software firms, are threatened if the AI revolution actually goes too well and makes their products obsolete. We've already seen a software apocalypse in the markets, with stocks plummeting and investors redeeming from private credit funds. Here's the stark difference. A normal life insurer has a pretty modest mix of blue-chip corporate loans and treasuries, with about 13% in alternative assets like private credit. But for a private equity-owned life insurer, David Dan points to research by two academics, one from Texas and one from Yale, who found that about half of their loans are in private credit and things of that nature. Half. These are much riskier bets. These balance sheets have become dumping grounds for loans that aren't performing well, loans in forbearance, where the borrower doesn't have to pay right away. It's a very dangerous game, and one that lacks the transparency and oversight of traditional banking. So what does this mean for you, the person listening right now? Let's trace the consequences. First, for your taxes. If one of these large private equity-owned life insurers like Athen were to go insolvent due to a downturn in the AI market, the surviving insurance companies would pay to cover policyholders. But then, in those 44 states, they'd get a tax credit for the full amount. That means the state government, your state government, loses tax revenue. And how do states make up for lost revenue? They raise taxes on you, the citizen, or they cut public services. Less money for schools, for roads, for public safety. It's a direct transfer of risk from private investors to the public purse, a hidden burden on every taxpayer. Next, for your investments. The incredible amount of money flooding into the AI space, like that $500 billion deal with NVIDIA, is built on the premise of endless growth and ever-increasing capital expenditures for things like data centers. But we've seen reports of Chinese AI models that require far less capital. We've seen the extreme expense of current frontier models like ChatGPT. There's growing backlash to data center buildouts in communities. If the current model of throwing hundreds of billions at capital expenditures goes sour, and those private credit loans underpinning it start to fail, it creates a cascade. A popping AI bubble could trigger widespread insolvencies among these highly exposed life insurers. This isn't just about AI stocks, it's about the broader financial system. And the ripple effects could impact everything from your 401k to the value of your mutual funds, potentially leading to significant market volatility. Finally, for your local economy, think about the backlash to data center construction. These projects are often financed by these very private credit loans. If these projects halt or fail, it impacts local jobs, local tax bases, and local infrastructure. And if state funds are then diverted to bailout life insurers, that's less money for local communities to address their own pressing needs, exacerbating local economic challenges and potentially leading to cuts in essential services. This is an untested system. We haven't seen mass life insurance insolvencies since this backdoor bailout mechanism was put in place. In 2008, AIG, a major insurance company, went insolvent, but the Federal Reserve stepped in, and Congress blessed that action through the TARP program. That was a federal response. The concern here, as voiced by the researchers from Texas and Yale, is what happens if one of these private equity-owned life insurers goes under at a time of macroeconomic stress. You'd need 50 separate state programs trying to resolve it. That's a recipe for chaos and a direct hit to your state's financial health, potentially creating a crisis far more complex than anything we've seen before. So, what's my read on this? The evidence suggests that a significant portion of the AI boom is being financed through a system designed to offload risk onto state taxpayers if things go wrong. We're in uncharted territory with the scale of private credit and its integration into these life insurance portfolios. I expect that over the next 6 to 12 months, we will see increasing pressure on state insurance commissioners and, more importantly, state budgets. As the AI build-out continues to face headwinds, whether it's from cheaper alternative models or community backlash against data centers, the vulnerabilities in this system will become clearer. The question isn't if these loans will face trouble, but when and how quickly the state-level bailout mechanism will be tested. The number I'm watching is the National Association of Insurance Commissioners' public statements and any new regulatory proposals they put forward, or any changes in bond yields for states with high exposure to these private equity-owned insurers. That will tell us just how much the market is beginning to price in this hidden risk. I'll see you next time.